Hello options traders, and a special welcome to all of our new traders who have just recently joined. I mentioned in a previous video entitled Look Left that calls are puts and puts are calls. I've received a lot of emails from people going, what? How is that possible? And I was making the point in that video that once you understand the benefits of rolling, and that it would show you that when you're rolling your call options, you really are buying puts, and that you are playing the downside as well as the upside. It opens up a whole new world for hedging and understanding strategies. So when you do that, especially when you're new, it's so important to understand that these are the same instruments. Any strategy you can build with calls can be built with puts and vice versa. So why is that? How is that possible when they look so different? Well, it all stems from a very basic mathematical connection, one of the more powerful, probably the most important in all of options theory and option pricing, called put-call parity. And from this formula, we can show that calls are puts and puts are calls. In fact, the word parity is just a fancy word for equivalence. And so again, this mathematical formula is just showing the connection between calls and puts. So I often tell traders, think of it like looking at the number 0.5 and the fraction 1/2. They look different, they're built differently, they're using different digits, and yet they're exactly the same. And you can see where people could look at this and go, how is that possible? And that's really exactly what's happening here with calls and puts. So you should think of calls and puts more like north and southbound lanes, let's say, of a highway. Everything's the same between these two. They go through the same cities, the same speed limits, the same laws. Everything's the same. It's just the direction. And so if you're in the northbound lane and you do a U-turn and start going in the southbound lane, then obviously you're doing exactly the same thing as everybody in the southbound lanes. It's just a question of which direction. And that's what's happening with put-call parity. It just depends on how you hedge your deltas. If you have a put option with negative deltas and we hedge it with long stock, I can turn it into a call. If I have a call and I hedge it with short shares of stock, I can turn it into a put. It just strictly depends on which direction I want to go. So when I talk about direction, I mean deltas. So to understand a little bit more about how this works, let's do a comparison. But before we do that, understand a very important principle of finance. And it says that if two assets, or a combination of assets, have the same outcomes in all situations, then they should cost the same. They are exactly the same thing. So let's compare a trader, one who buys a 1-year $100 call, and he's also going to invest some cash in a bond. Now he needs enough cash so that when this bond matures, it grows to $10,000, which is exactly what it would cost to exercise this call option. So I'm just making it up and saying that if interest rates are 5% in this bond, he would have to spend $9,524 cash, and it therefore matures to $10,000 in 1 year. Now we're going to take that trader and compare it to another one who buys stock today and then buys a 1-year put. So notice something very important right now. The second trader here who buys the stock today and then buys the put is in a roundabout way just changing the timing of the cash flows. The person who buys the $100 call could choose to buy the stock in 1 year. So it's just a question of whether we do it today or whether we do it a year from now with those deltas. So think about that right now. You can kind of start to see that as this unfolds, they are exactly the same. It's just a timing of when we buy the stock. So for instance, here's our $100 strike. And let's say that the stock is above this, anywhere above it at expiration in 1 year. What's going to happen to the two traders? Well, the $100 call exercises, and he's going to get 100 shares. Where will he get the cash from? From his bond. He set that cash aside. Rather than buying the stock today, he put it to the side in a bond. What's going to happen to the other trader who bought the stock plus put? He's just going to let that put option expire worthless. And guess what he's holding? He already bought the shares. So he will also have 100 shares of stock. So notice right there in blue, what do you notice? If the stock is above the $100 strike at expiration, both traders can end up with 100 shares of stock. They're exactly the same thing. Well, what happens if the stock, in fact, goes down? Doesn't quite make it to that strike? Well, the person who has the $100 call is going to let the call expire worthless, and he'll be left with $10,000 cash from that bond. What about the person who bought the stock plus put? He can exercise that put, sell his shares for the 100 strike, and collect $10,000 cash. Once again, look at the two traders. They end up with $10,000 cash. So no matter what happens to the stock's price, both traders end up in exactly the same situation. And therefore, a call and a put should cost the same. So let's jump over to the CBOE's pricing model and take a closer look. So now we're at the CBOE's website, the Chicago Board Options Exchange, and let's go into this pricing model. I'm going to say that the stock price is 100. The strike that we were looking at is 100. Days to expiration we assumed was a 1-year option. Volatility, for right now it's not going to matter. I'm going to put 20%. Interest rates, at least for our bond, were assumed to be 5%. And I choose calculate, and we see that the call option should cost $10.33 and the put should cost $5.57. Now you might think, hey, wait a minute, you said that the call and the put should cost the same. Why is the call so much more expensive? Well, because remember, the person who bought the call doesn't need to buy the shares of stock today. He instead invested it into a bond. And so the call option is obviously got to account for that cost of carry. Remember, there's nothing free in the markets. So yes, he's collecting more interest than the person who buys the stock and the put. So the market's going to charge him for that. And if it weren't accounted for, there's actually what's called an arbitrage opportunity. So we know for a fact the call option has to include the cost of carry. So one way to understand this is to look at the difference. $10.33 and $5.57 is a difference of $4.76. So think about this. If you invest $100 into a bank at 5% interest, that's $5 of interest you earn in a year. But what's it worth today? Well, we'd have to take the $5 divided by 1 plus the interest rate, or 1.05, and that equals $4.76. That's why there is a $4.76 difference in them. Now we could show it another way. What would be the minimum price of the call if the stock had no volatility? Let's change this to 1% and watch what happens. Now the call is worth $4.76 and the put is worth 0. Again, the call price exceeds the puts by the cost of carry. So this just shows that it's just strictly a difference of the cost of carry. Now we could come back here to 20%, and I could also do this. I could also make interest rates 0, and now we'll see that the call and the put cost the same because they are doing exactly the same thing. It just depends on if we wish to hedge that with shares of stock, and if so, when are we going to pay for the shares? So if we go back to that previous video, I talked about Home Depot, and for example, when the stock price is making these nice long runs like this, all I'm doing is rolling. And by rolling, I am mathematically buying puts. You see, too many times traders want to sell their calls at a point that they think is a top, buy the puts. If the stock falls, they sell their puts, turn it into cash, buy the calls, and go long. It's way too much trying to time and trying to trade on what you think. Instead, if you understand that calls are puts and puts are calls, when we are running like this, if we roll, and I'm buying those calls as part of that roll and putting cash in my pocket, I am buying puts. I'm just putting the cash in my pocket today instead of out at this point. So if the stock does in fact fall, which is part of our long-term expectation, we're going to get pullbacks, I can then add to my calls. And it's exactly the same thing as if I bought the puts. The difference is when we're at these highs, I'm not trying to say that we're at the high. I'm not trying to guess at. I'm leaving my deltas on, albeit reducing them, but I'm also putting cash into my account to take advantage of the times when we get these falls, because these are enormous opportunities if you have the cash. So how do those strategies all come about? It comes from understanding that calls and puts aren't apples and oranges. They are far more alike than they are different. In fact, depending on how we hedge them, we can make them exactly the same. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsa2z.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.